Radhika, hi, good morning. Let me kickstart the discussion with India. Considering the currency is now trading at fresh two-year lows, what to your mind are the factors playing on it right now, and what could be sort of depreciating the currency?
Since in the past week, the rupee has depreciated by about over 2%. Of course, it's still in the middle of the pack. I mean, there are, as compared to the regional currencies where some have fallen by more than 4.5%. I think the primary factor that's been weighing in is obviously, there's a major economy that has depreciated currencies, and it's coming in wake of the euro, yen also pushing down their currencies to make it more competitive and help the economy reflate. Hence, the other economies also follow suit. But I think talks of any currency war are exaggerated at this stage. For the rupee in particular, what's happening is the yuan is weighted pretty strongly on the rupee real effective exchange rate. To that extent, if the yuan falls, rupee looks more expensive by relative to the yuan. So I think that is where the authorities have been a little bit more tolerant than usual for allowing the rupee to adjust lower. But I think it's again pretty much in line with what's happening in the regional currencies. So India is not unique in that perspective. I think we also need to look at the broader reason why we do have, our DBS currency economist does expect the dollar rupee to get into the 66 handle in the coming months. And that will have both domestic as well as external considerations in play. So yuan, I think, is something that's a very near-term risk. And like I mentioned before, that's why we have seen the rupee fall to the levels that it has done into the 65 handle.
Radhika, same time last week there were fears that yuan could go through a painful adjustment, and it could be an engineered adjustment. But I guess global market watchers have realized that we should not worry about the China currency devaluation. I guess what China is trying to do is that they're trying to achieve their long-term objective, which is trying to make the Chinese currency more like a reserve currency.
Yes, that would be true also, because the yuan in particular has also been quite strong on its own real effective exchange rate basis. So while the rest of the currencies were adjusting in the past couple of months to the dollar strength as well as the euro and yen fall, yuan was relatively stable. So it has, in fact, our currency economist does mention that it's even above the 2% standard deviation from its mean. So that is very high by relative standards. So that's kind of adjustment could be expected. But I think whether this means that all the currencies need to adjust lower, or this means that it will be a significant boost to its own domestic economy, that remains to be seen. The IMF SDR inclusion is certainly something to look forward to. The timeline has been, might be pushed to about September 2016, but yes, to make the yuan more market controlled rather than by the authorities is one step in that direction. To make it more market oriented, on a level about fixing, where do they have the fixing on a multi-day level, that's all small steps being taken towards the larger goal of making the currency more internationalized, so to speak.
Radhika, back home, monsoon is almost at the fag end. You've got earnings season which is, out and done with. The monsoon session of the parliament was a complete washout. What I'm trying to get to is the domestic factors are all done with. And it seems that India is now going to focus more on global factors at play. What's the sense that you're getting about what could be a bigger threat to India right now? Would it be the impending Fed liftoff, or do you think there could be some more easing or stimulus measures from China which could play spoilsport for us?
I think both these factors need to be watched for. Of course, the yuan devaluation wasn't really expected, so that was a surprising move, which has thrown back, Fed expectation fears to the back burner for the time being. So what would be of more importance to India? I think we need to watch what's happening domestically. The monsoon parliament session wasn't productive in terms of getting the key reform bills done. There is news that there could be a special session starting off next month, and it remains to be seen if at least the GST bill will be able to, the amendments can get through with all the respective states' approval. And the growth front, we've seen inflation come off quite sharply, in fact, in July, which has raised the odds for the RBI to move come September. But the RBI is also looking at the same time at what's happening externally. So yuan devaluation is one aspect, and the other is Fed. The rupee has weakened quite a lot because of the yuan move. So does that mean that the RBI will be more cautious in cutting rates in September? I think it remains to be seen. We'll be watching their comments quite closely. But as far as Fed is concerned, the FOMC minutes due this week will give us some better clarity on do they expect a lift off in September or December. Our expectations are that December will be the first of the rate hikes, and if that comes to pass, the RBI has another reason to remain cautious in the run-up. So the factors leading to the September policy review in particular are quite mixed, but both these external risks, I think, should be balanced, equally watched. So flare up in either, I would think, would leave the RBI more cautious than not.
Right, Radhika, really appreciate your time and thank you for joining us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.